Hello and welcome back to All Things Money. I'm your host, David Blain. Just wrap up this segment we were talking about last segment. Mark Yusko is out as the investment chief at the endowment fund, a hedge fund of Morgan Creek Partners. Anyway, if you missed the first segment, head on over to the website, www.dlblain.com. We'll post archived copy of the show there in a week or two, and you can catch up. But this report that came out back in January, nothing against Mr. Yusko. I'm sure he's a good person, and I'm just using his story to illustrate a couple of points. Number one, be very wary of chasing these star performers. Jim Cramer on TV, I think that's his name, on CNBC, Cramer, or Warren Buffett. I can't tell you the number of people that have tried to duplicate what Warren Buffett has done. It's just not possible. So beware of chasing these star performers. That the best method for 99.9% of the people to invest is to get a long-term plan, have an investment advisor that knows what they're doing, build a diversified portfolio, and only change it in response to your changing goals, or if things in the capital markets change substantially, like for example the market bottom of 2009, maybe a good time to add a few stocks to your portfolio. But anyway, the second lesson learned was hedge funds. Stay away from hedge funds. I've said this many times. The allure of hedge funds and being able to beat the market and non-correlated with the market. If you look at a lot of the hedge funds in the financial crisis, they went down right along with the regular stocks, but did not recover as well. And so what used to be promoted, I've heard them promoted as a way to beat the markets. I've heard them as a way to a bond substitute, as a diversification, correlation. And I realize different hedge funds do different things. Different hedge funds have different objectives. But the reality is that space is becoming extremely crowded. A lot of them are trying to make the same trades, and we just recommend people stay away from it. The same thing with the endowment model. Now, the endowment model comes from the Harvard Endowment Company that manages the Harvard University Endowment. And they invested in a lot of esoteric type investments, timber, and they were an early mover in the private equity markets, things like that. And there's nothing wrong with that, but what happened was people looked at those results and said, oh, wow, they're doing great over there. Let's try to copy what they're doing. And so you saw this huge surge in interest in things like timber and the hedge funds and private equity and things like that. And the returns have largely been disappointing for people. And that's simply because it's not so easy to duplicate what Harvard did. In fact, in the timber arena, they owned vast tracts of forest. They went out years and years and years ago and bought the thing. And so people flooding into these markets today are just not seeing the returns that Harvard got. And that's exactly what happens is if you have whether it be an industry, such as the personal computer or investing, whenever you have a lot of capital flooding into a market. Take the computer, for example. The computer came out initially, and it was sort of a novel thing. It started to take off. And if you remember back in the probably the early 90s, all through the 90s, the beginning of 2000, if you were a computer maker, Dell and Gateway, Hewlett-Packard, and a bunch of other companies that are no longer around, they were making a lot of money selling personal computers. Well, what happens is as an industry becomes successful, people look and say, oh gosh, look at the margins in the computer business are 30, 40%. Let's go into the computer business. And so capital floods into that industry. It drives the margins down, drives the profits down, to eventually it squeezes the profits out. The exact same thing happens in investing. As you see something, and I think to a large extent this has happened in commodities. The mechanics are a little different, but you have, corn futures, for example, and farmers hedging their production, and you have speculators and hedgers in the commodities market, and they largely kept each other in balance for years and years. Well, the past 10 or 15 years, there's been a huge surge in interest in commodities, and so you have this flood of capital into the commodities market that, some people say drive the price up. I don't necessarily agree with that, but it drives the profit out of the market. Whether the price went up or down, it drives the profit out of the market. The same thing with the personal computer. In that particular case, it drove the costs down and the profit out, but it doesn't necessarily, in the investment world, doesn't necessarily have to drive the price down, but it drives the profit out. The same thing with private equity. You had years and years ago, only the very top investors would be involved in private equity, myself included. We used to do a lot of private equity back 10, 15 years ago, and then people started flooding the space with money. And so you had, private equity goes out and it buys existing companies and helps them grow and takes to the next level and then sells them. Venture capital is for startups, and we're talking about middle market private equity. So you have this, a manufacturing firm out there that's worth, say, $25 or $50 million, and a private equity firm would come in and help them go to the next level and sell it a couple years later for, $100 or $200 million. Well, what was happening is all these firms had so much money, they were going to these small companies that were worth maybe 25, 50 million, and they were outbidding each other. And so before you knew it, they were paying 150 million and then trying to turn around and sell it at a profit. Well, remember in the example I gave you that this company was ultimately sold 5 years later for 200 million. Well, that was based on buying it at about 25 or 50 million. So as more money flooded in the private equity, basically drove the profits out. And so that's what's happened with a lot of these esoteric type investments, the Harvard, the endowment model, hedge funds, so much money flooding into that space that it's driven a lot of the profits out. Okay, so once again, just to kind of summarize using this example, we don't want you out there chasing star performers. We would like to see people stay away from hedge funds. And number 3 is be very cautious when trying to copy someone else's investing strategy, especially the endowment model of a Harvard, that throws around billions and billions of dollars in the marketplace. All right, well, that brings us to the end of our second segment. When we come back, we'll start talking about some of the AIG bailouts. So for All Things Money, I'm your host, David Blain. We'll be right back.